Greetings, everyone. I hope you are having a great spring. We are back with another market commentary video. Today is Tuesday, April 30th. The month is almost over. Most of you will get this on Sunday, the 5th. So this was the worst month. April was the worst month of 2024. The flip side of that is 2024 has been a pretty good year. It's been a historically docile year, meaning the narrative is often markets are volatile. Equity markets are supposed to be volatile. That's normal. Looking at 2024 through the lens of history, this has been a pretty calm year despite all the geopolitical and economic things going on. The false start with inflation. What does the Fed do next? I kind of chuckled. Last month we talked about 3 cuts in a bull market. The market and the Fed were aligned. You get a monthly inflation report that's a little higher than most people expected. Now, fast forward, April was down. Pretty much everything was down except for commodities and gold, and markets are acting crazy again. So just when you think you have it figured out, inflation throws a wrench in things, and now the market and the Fed is pricing in 1 or maybe even 0 cuts in 2024. So let's get into the slides. We've got some info on market dynamics, intra-year drawdowns, the wild swings of big tech, some metrics on inflation and investor sentiment. All right, so like we do in every month, I look back at major asset classes that our clients are invested in or that you might own as a potential client. Starting at the bottom, Bitcoin, since its launch in, I believe it was early March or February, had a nice run up, sold off a bit. It's a noisy, volatile asset class. That's not a surprise. This is real estate, this lime green, small cap, the Dow Jones, S&P, foreign stocks, bonds, treasuries. Surprisingly, emerging markets had a pretty good run in the month of April, despite most global markets going down. Bonds held up relatively well. You see short-term treasuries here, SCHO, essentially flat. And gold continues to be a nice hedge, not only against inflation, as we'll see later, but also against the geopolitical risk. I talked about in a previous podcast how the move in gold was potentially signaling a geopolitical conflict, and then Iran and Israel started dropping bombs on each other, thus justifying the move higher in gold. So it's nice to have some of these other asset classes that act differently during times of stress or when risk just pops out of the bushes and derails more risky assets like stocks. Okay, so let's look at intra-year S&P declines versus the ending calendar year return. So basically what we're trying to capture is, since 1980, what is the average intra-year drawdown? Intra-year meaning just January from December, what happens in the middle of the calendar year. So that's outlined in red, okay? And then the ending year return, you can see the years are down here in this bottom axis. This is where we're at year to date. I think this is as of March 31st, 2024. You can see, back to my opening comments, this has been a pretty calm year. Of course, April came, and this looks like 6% in intra-year drawdown, intra-year drawdown of about 6% now. But when you compare that to the average intra-year drawdown for any year since 1980, it averages about 14%. So all that means is, in an average year, the market does sell off about 14% on average. You can see some drawdowns are steeper, like during times of stress or crisis. This is back in 2008. This is during COVID. And I'm still shocked by this huge range of outcomes in 2020. The market was down at one point 34% and finished the year plus 16%. That's just an unprecedented swing. But again, the story is, one, it's normal to get a pullback. It's normal to get a 14% on average pullback during a calendar year. And then 2024, despite all that's going on, has been historically calm. And you can see that here. Again, this is a month old, but this still holds even if you move this -2 to -6% and you scroll to the left. That's still pretty calm by historical standards. Okay, so we've talked quite a bit about inflection points. And an inflection point is simply a good market giving way to a poor market, or a poor market giving way to a good market. And what we've done here, and this is a JP Morgan chart, but we've looked at inflection points over the past 25-ish years. Okay, so we've marked some of these seminal moments right before market sentiment changed for the worse. and we're looking at forward PE. So this is just a measure of how expensive a market is, how frothy stocks are. The higher the number, the more expensive the S&P index is. So we're talking about the S&P here. This goes back to 1996. This is the index level, and this is present day right here, again, as of March 31st, 2024. But what's interesting here, again, we're looking at index price to earnings ratio. The bigger the number, the more expensive. And you can see 2000 was like the peak of the technology froth and excess. 2007, that was on the doorstep of the financial crisis. And you can see stocks were trading at reasonable levels. I believe this is at or below the historical average for PE. And then looking at 2022, coming off 2021, that was a very aggressive year where everything was up. It didn't matter if you owned NFTs, crypto, speculative assets, it was all up. And the PE at the start of 2022 reflected some of those frothy levels, U.S. large caps and pretty much everything. And then this is where we're at today. So some folks say that U.S. large cap stocks are at an inflection point. They're due for a correction just because of the top heaviness of the big tech companies driving the S&P higher, and it's trading the lens of history at a rich value, meaning stocks are overvalued in some people's eyes. Okay, but as you can see, some of these numbers were on the doorstep of a crash. Stocks were historically fairly valued here. They were overvalued here. We know what followed. This was a pandemic, so I'm not really going to talk about that. And then on the doorstep of 2022 sell-off, stocks were again fully or even overvalued. So there is some relationship between fully valued stocks and lower future returns and potential inflection points. Now, the caveat to that is what's expensive can stay expensive. Just because something is trading fully doesn't mean it's due for a correction. And I've always said that the valuation of an index, a stock, or any asset class is a lousy timing tool. One thing that I find compelling is stocks or any asset class doesn't trade in a silo. There's competition from other asset classes. So some argue that one of the catalysts, of course, the banking system collapsed back in 2008. But aside from that, one of the catalysts for the unwinding of equity markets was the competitiveness of the bond market, where an investor is looking out at the horizon saying, hey, there's all these things going on. Banks are failing. I can park my money in a U.S. Treasury, a 10-year Treasury, and get almost 5%. Like, that's a rational trade when the world's on fire. Some people are saying that now. Like, why would I speculate and reach in AI stocks or the S&P when I can park my money in a money market fund and get 4 to 5%? So again, we don't make predictions here, but certainly the setup, if you're a long-term investor, if you're looking out at the opportunity set, U.S. large cap stocks might look less attractive and some of these other safer asset classes might look more attractive. And this is another look at where we're currently trading for the S&P, and this actually isolates the largest 10 S&P components. So think the largest tech stocks, and we're breaking those down by initial median price divided by revenue. Okay, so price divided by revenue. And again, the higher the price in the numerator and the lower the denominator the revenue is, the more richly something is trading. Higher price, lower revenue, the more fully valued or overvalued something is trading. Okay, so the higher the number, the higher this ratio, the more fully valued or overvalued something is. In this case, we're talking about the largest 10 S&P 500 components. Okay, so that's on the bottom axis here. On the vertical axis, we're showing at various levels of price to revenue ratio future returns. So subsequent annualized average returns. All right, so there's a lot going on here. What I wanted to point out is 1999 and 2024, where we're currently at. Again, this is as of March 31st of 2024. So back to that previous slide, I showed the inflection point. Stocks in 1999 were overvalued. Stocks in March of 2024, and again, in this case, the top 10 components of the S&P are historically overvalued. Thus, future returns based on history, going back to 1988 or 1985, it looks like, could be lower. All right, so if we're here, that's a price to revenue ratio of 8, which is historically an outlier. right? There's only one other year that even comes close, so 1999 and 2024. And if I hover my mouse over here to the left, that could mean average annualized returns for the next 10 years could be negative. And that's every year. So this is showing from, let's say, 2000 to 2010, that was the lost decade, right? So S&P 500 stocks, and I know this is the top 10, but the S&P 500 from 2000 to 2010 was essentially flat. People call that the lost decade. And many point to the high, rich values at the start of that decade as the culprit, all right? So the reason why I hammer on this is because a lot of investors tend to overweight what just happened. Well, what just happened is the S&P's been a juggernaut really for the last decade plus. And we're seeing a lot of prospective clients, a lot of clients want to pile into the S&P 500, okay? Investing's not that simple. What's worked often is out of favor. And again, it's current value is a lousy timing tool, but there is empirical evidence to suggest the higher you pay for something today, the lower future returns that could be tomorrow. All right. And then let's look at the opposite. So back in 2009, we just had the 2008 crash. Stocks actually hit bottom in March of 2009. Looking back, that turned out to be a generational opportunity to pile money into beaten down U.S. stocks. You can see the largest 10 S&P 500 components price to sales was just over 2, and future 10-year returns annualized were 15% a year, okay? So oftentimes investors do the opposite, where stocks are going up, they want to get more aggressive, they want to own more stocks, they might say, why am I trailing the S&P? In fact, that could be a time to exercise some caution. Conversely, when there's blood in the streets, people are fearful, they're selling stocks, that's often the time to get more aggressive or take idle cash and to get it into the market or get more aggressive within your asset allocation. Unfortunately, most investors tend to do the opposite. So again, it's helpful to engage with history to understand how these ebbs and flows and cycles work. All right. So another thing that we're seeing is many new clients of ours, prospective clients that come on board either from other advisors or they're do-it-yourself investors. A lot of our clients are retired. I'd say 70 to 80% of our clients are retired or on the doorstep of retirement. What we're seeing is just an over allocation to tech, just an overweight to tech, often a redundant exposure to tech, and I'll explain what that means. But what I wanted to show here was just the sheer wide range of outcomes that come with big tech, which are often seen as like can't miss stocks, which again, these stocks have done great. My job is more of a risk management lens, managing the position sizing, making sure we're not over our skis, or at the very least, we understand the risks that we're taking. So what we've done here is outlined the journey for the S&P minus the 7 biggest tech stocks, and then the 7 biggest tech stocks. And the 7 biggest tech stocks are Amazon, Apple, NVIDIA, Tesla, Microsoft, Google. Okay, so those are the big 7 I'm talking about. So in 2021, those stocks were up 40%. If you take the top performing stocks, the 7 biggest tech stocks out of the S&P, the index was up 17%. In total, in 2021, the S&P was up 27%. Great year. 2022, that was an awful year for pretty much everything. Higher rates and higher inflation. Those same stocks were down 40%. That's crazy. These are huge, profitable companies. It's not uncommon to see a micro cap stock or a small cap stock sell off by 40%. It's very rare to see the biggest company in corporate America, the biggest companies in the S&P sell off by 40%. That is just a seismic move. Okay, so when you strip the largest 7 tech stocks out of the S&P in 2022, the index was down 8%. Again, adding those back in, looking at the actual S&P performance, down about 19%. Then we got the AI movement, the launch of Chat GPT in the fall of 2022. Those 7 large tech stocks went to the moon again. You strip those out, the S&P's up 8% in 2023. You add those back in, the S&P's up 24%. So what I'm trying to do is just isolate the wild ride of some of these large companies. And again, this is as of the end of March, I believe. I don't believe this number is accurate. These big tech stocks have sold off a bit in the last couple weeks. But I think the message is clear where we're getting these wild swings. The S&P is more like a technology index now. And back to what I'm seeing in prospective clients is they're owning a lot of these big 7 tech stocks outright. So they own large positions in these individual stocks. And then on top of that, they own the S&P 500 as their largest index exposure. So what that means is they have double exposure. The S&P index is roughly 33% of these large tech companies, and then you own them outright in individual stocks. So your total exposure is more like 40 or 50%, which works well in 2021 and 2023, but can be disastrous in years like 2022. So the case that I'm making is be mindful of the risk that you're taking. Don't get over your skis. Don't get emotionally attached to any of these large companies that have done well. A potential retiree or someone that's retired probably doesn't want to introduce these wild swings in their portfolio, right? I always talk about what good investing actually is. Good investing is generating reasonable, consistent returns over the longest period of time. It's about building an investment portfolio that you can stick to when times are good and when times are bad. When you introduce these wild range of outcomes, people end up embracing risk when times are good and shunning risk and trying to sell stocks when times are bad. And they end up market timing. They end up making all sorts of mistakes. They end up selling things and saddling themselves with a large tax bill. It just reinforces the wrong behavior. So one of the things that we do at Pure is just try to achieve a tighter range of outcomes. We're trying to keep it on the rails, especially for folks that are retired. And again, it's okay to own these companies, but you should be hyper-focused on your total risk exposure, your risk management process, your framework for making decisions when things get difficult. And if you've had an episode where you've sold stocks in the past at the bottom or acted emotionally based on what your portfolio is doing, you're probably taking too much risk. Okay, so inflation, the battle's not over yet. And I think this might be a little blurry, but I'll try to talk around that. So we got a couple false starts on inflation with the monthly reports. And I always show the core PCE. And PCE is personal consumption expenditures. It's the Fed's preferred way to measure price changes for goods and services that consumers purchase. Okay, so this is what the Fed is looking at. And you can see a big component of this is rents. So what people are paying in rent, it's come down, but it's still elevated. So this is a large component. And of course, rent can be noisy. I mean, look at this journey from coming out of the pandemic to 2021, and then 2022 it fell, and now you're getting these pump fakes here, up and down and up and down. So that creates a noisy environment. And that's what happens on these month-to-month reports. And I feel like investors probably overreact when they get a good report and overreact when they get a bad report. But the Fed desperately wants to get this back down to their mythical 2% target. Right now, it's a little bit higher than that. And you can see how unenviable and how difficult the Fed's job is trying to make monetary policy decisions based on noisy monthly data that's backward looking, okay? So look how choppy this has been, where we made a lot of progress when rates are going up, then prices spiked, and now they receded, and then you're getting this false start. So coming into the year, the market was pricing in 6 interest rate cuts, and 2023 market action, stock prices went up, foreign stocks went up, pretty much everything went up in value in anticipation of the Fed cutting rates 6 times in 2024. Those expectations have slowly fallen off the wayside. Instead of 6 cuts, the Fed is talking about 3 cuts. Instead of 3 cuts, we could potentially get 1 cut or 0 cuts. So some of the noise that you've seen in April is in direct response to some of these noisy inflation reports. Okay, so if you're a retiree or if you're an investor, this type of environment is why you own some of these other asset classes. No one knows what happens next. Again, tighter range of outcomes, a risk management lens. We're going to get into some of the assets that have held up well in the face of inflation. And I think this is a really cool chart here where we're essentially tracking, and I'll move this again. We're essentially tracking the last couple years going from a no inflation or a low inflation environment, getting into 2022 where inflation really raged higher, all right? So we've got oil, gold, copper, the S&P, U.S. Treasuries. I believe this is 10-year, and TIPS, or Treasury Inflation Protected Securities. And we're outlining how each of these assets did during an inflationary environment, okay? So we highlight a couple of these points and how inflation impacted each one of these asset class returns. So green is positive, red is negative, dark red is really bad. Okay, so looking back at the last couple of years, we can see the traditional inflation hedges of oil and gold held up pretty darn well over the past couple of years. Copper, which is, some say, is a measure of economic activity, was kind of mixed. It was down slightly. S&P, which not a lot of people think about stocks as an inflation hedge. Stocks are a pretty good inflation hedge, and I wrote about this a couple of years ago. Companies, and we've certainly seen this, can pass along higher prices to the end consumer, which flows through to earnings. So historically, although stocks can sell off and certainly act poorly during times of inflation, stocks over the longer run, during longer inflationary periods, tend to do quite well, okay? And I think the numbers show that here, but this is not a smooth line. So, go back to 2022, stocks were down by 19%. They certainly bounced back in 2023 despite still higher inflation. What's not a shock is these longer maturity bonds less well, okay? So if you're loaning money out for 10 years and you're getting paid back in 10 years with interest, and each one of those dollars that you're getting paid back is worth less due to inflation and prices going higher, then the underlying value of that bond has to go down. And again, these are 10-year treasury bonds, so your money's essentially locked up for 10 years. Prices going up, the value of the dollar going down, you're getting paid back with less dollars. I think the downward price movement of longer-term bonds makes sense. Know that one of the things that we were doing back in 2022 was shifting out of some of these longer maturity bonds and buying short-term treasuries. So if you look back at 2022, really the only places to hide were cash, which rates were going up, so you could still get some sort of decent yield in a money market fund, short-term treasuries, gold, and oil. Okay, so we didn't have any direct exposure to oil, but we certainly own plenty of gold and short-term treasuries. One surprising thing for some investors is TIPS didn't hold up all that well. And again, TIPS are Treasury Inflation Protected Securities. Well, there wasn't much protection because you can see a lot of these bonds were still down. And what Treasuries do is they adjust your interest payments higher over time to mirror some of those price increases or CPI increases. Basically, higher interest payments over time to combat higher prices. Okay, so that's the good component of TIPS, and that's part of the reason why that they were down less, because their interest payments adjust higher as prices go up. However, TIPS are still very much bonds, and your money is lent out, and you get paid back over time. And it's still exposed to the real rate. And when the real rate is moving higher, when interest rates are moving higher, these TIP bond prices are still going down. Okay, they're just going down less so. Part of the reason is, again, those interest payments adjust higher based on inflation. So we get questions all the time. What happens if inflation is sticky? What happens if inflation goes higher? This is your answer. Own other asset classes outside of bonds, outside of equities, just to smooth out the ride. Because while equities are positive over the longer term, over a multi-year cycle, let's say, they can be noisy. Look no further than 2022, but historically, commodities, oil, gold, cash even, if real yields are high enough, can be a decent inflation hedge and, again, help mitigate some of those large drawdowns. Okay, last slide. This one's near and dear to my heart. So it's not a secret that we track sentiment. Sentiment is essentially how investors feel about future market performance or future market returns. And something interesting has happened over the last 20 weeks, and it's not a surprise because I always say that sentiment follows price. And all that means is when markets are up, investors feel better. When markets are down, investors feel poorly. Okay, and that runs kind of counter to how markets actually work. And this is a really good data set to show that. So S&P performance after 20 weeks of positive bull-bear spread. So all this essentially means is investors, as markets have rebounded, as the S&P has performed well, are starting to feel more optimistic about future equity prices. Price is up, investors feel good. They think the positive price action is going to continue. It's been that way for 20 plus weeks. Okay, so there's more optimists than pessimists as it relates to future equity returns. What we've done, going back to 1992, is track S&P performance after 20 plus weeks of there being more optimists than pessimists. And you can see that here. We track 1 week, 1 month, 3 month, 6 month, and 1 year. I don't really care so much about 1 week or 1 month, but I think 3 month, 6 month, and 1 year show the same consistent story. And that is, when investors feel the best for a long period of time, future returns are often lower. Okay, so what we're showing here is after 20 plus weeks of being bullish or optimistic on future equity returns, 3 month, 6 month, and 1 year returns are lower versus all other periods. So here, 0.38 versus 2.11 for 3 month, for 6 month, a little less than 3% versus 4.5%. And then 1 year, about 5% versus almost 10% during all other periods. So again, sentiment is a telling piece. When all your friends and everyone's saying markets can't help but go higher, and they're bragging about all the money they made in NVIDIA and Microsoft and the big 7 tech stocks, that could be time to exercise some caution. When people are beaten down, they're talking about a crash, a depression, everything's selling off. That might be a time to get more aggressive. And you can go back 100 years. It's the same rhythm and rhyme with the way investor psychology works. So again, I'm not saying this should be your sole input, but this is a very important component to our rules, and it's a very important piece into our investment process. So that does it. If you have any questions about the market action, or you're a prospective client and you're a lurker and you read our stuff and you watch our videos and you have a question about how we work with clients, feel free to shoot us a note at insight@pureportfolios.com. If you're a client and you have a question about any of this, feel free to reach out to your advisor or shoot us a note at the same email address, insight@pureportfolios.com. All right, thanks for listening. Thanks for watching. We will see you next month.